Very good morning. Thank you very much for joining us today on this webinar for the month of August, where we review the markets. I am Sudarshan. I head the Financial Research Department in ArthaYantra, and I will be taking you through today's webinar. So this is the topics we will be covering in today's webinar. We first look at the global macroeconomy. We look at the Indian economy. We look at the real estate in India. It's a topic that we haven't quite touched upon for quite a while. And we look at how the real estate in other economies are performing, and then we arrive at our investment strategy. Diving straight in, first we have a look at one of the economies that matters the most in the world, the USA. The Federal Reserve did not raise the interest rates in September. Why? Well, because the data has been mixed in August. There was a case of how manufacturing activity had picked up, but the actual employment numbers did not match up. And the trend kind of continued even in September as well. As you can see, the manufacturing activity did pick up in September. We had a PMI of about 51.5 compared to 49.5 in August. Now, by looking at pure numbers, you can't really tell it is expanding. Because if you look at what they are manufacturing, it is more of the back orders. Because the growth in the new orders that manufacturing companies are getting are actually lower. Now, the US GDP for the quarter ending June was revised upwards to 1.4%, whereas the GDP in the previous quarter, which was initially pegged at 3.4% in July, fell to 2.8% in September due to initial indicators of poor job data, and then revised once again to 2.4% in September 30th, and once again to 2.2% on October 3rd. Once again, because some of the indicators in the economy were not particularly robust. For example, here the construction activity and the investment activity fell, and this data was found on September 30th and October 3rd respectively, which is why the GDP forecast was also revised. If you look at the number of jobs that were created in September, it was about 156,000, which is down from 167,000 for the same period last year. But if you look at the number of jobless claims, it's actually much lower. It's at 254,000 in the last week of September, compared to the much less than what was expected of the 270,000. Now, if you look at these data, it's clear that the indicators are mixed. There is growth in some phases, but it's not. The underlying conditions don't quite support a sustained growth. So we expect that the Federal Reserve will not be particularly encouraged to raise the rates in the United States. However, if you do look into the statement of what the chair of the Federal Reserve said, Ms. Janet Yellen, she says that about 80,000 job creations a month is more than enough for USA because of the aging population, and at the same time, it won't be sustainable to give so many to create so many job opportunities in the future. Moving on to another economy of interest, Japan. Now, Japan, as you know, is primarily an export-driven economy. So just about every other famous brand that you know is based out of Japan. And because of this, they depend almost entirely on manufacturing. And the Japanese yen has been strengthening for almost over a year now. Presently, it is trading at about 103 yen to a dollar, which is a level not seen since the 1990s. Manufacturing activity expanded in Japan for the first time this year in September. It stood at about 50.4 versus 49.5 in August, the PMI that is. But if you look at overall Japan as a whole, the composite PMI fell from 49.8 in August to 48.9. This is primarily because there's a large drop in the service activity. And service activity is a primary indicator of how the consumption is in Japan, and also is an indicator of what the business sentiment is out there. So if you look at this particular drop, it is actually no surprise that consumer activity has also dropped. And because of a drop in consumer activity, Japan, which was battling chronic deflation since the 1990s and had managed to get a meager inflation of about 0.3% in August, was back to the negative territory. Similarly, if you look at the business investment activity, the activity index stood at 48.2 in September compared to 49.6 in August. So this is on a scale of 100, and anything below 50 indicates a decline in activity. Anything above 50 indicates an expansion in activity. So when it was 49.6 in August, it was dropping, but it dropped down further in September. The biggest, arguably the biggest developed economy in our current times is the European Union, and they too are facing a slowdown. As you can see in the table, a lot of the economies in the European Union had a composite PMI that indicated lows of many months. Ireland, it is also called a Celtic tiger because of its rather booming economy. The composite PMI of Ireland fell to 54.8, now the lowest it's been since 2013. Similarly, if we look at Germany's composite PMI, it's at the lowest in almost 1.5 years, and so in France as well as in Italy. Over here as well, we can see that even though there is a slightly there are slight improvements in pockets of activities, but overall there's been a drop in the service industry as such. This is primarily due to the Brexit. Britain has voted to exit the European Union, but the actual action of exiting the European Union is yet to take place. And Prime Minister Theresa May has indicated that this will not be taking place anytime after March 2017. So we can expect a sort of a deadline of sorts by March 2017. But until then, there is an uncertainty as to what will be the policies that Britain and the European Union will follow. Recently, there were reports that Britain might opt for a hard exit of the European Union. What this means is that it will completely exit the European Union and will opt for individual trade pacts with each of the countries. Thanks to this, yesterday there was a crash in the British pound sterling. It fell by almost 5%, which is lowest it has seen in 3 decades. This is also the worst fall that the British pound sterling has experienced since Brexit. But looking at some of the other indicators, consumption activity has picked up. The inflation has gone to 0.4% in September compared to 0.2% in August. But this is still far below what the European Union is targeting, which is 2%. Now moving to the second biggest economy, China. Now a lot of the emerging economies are entirely dependent on China, because emerging economies either export commodities or they are into manufacturing. If they export commodities, their biggest consumer is China. And if they are manufacturing, they have to compete with Chinese manufactured good prices. So the fate of most of the emerging economies depends almost entirely on China. Now, the Chinese economy has been losing steam a lot lately. Manufacturing activity had been dropping for over a year. So if you look at the Caixin manufacturing PMI, it read 50.0 last in August and 50.1 in September. So what this means is the uh, Chinese manufacturing activity is actually stabilizing. It is not expanding, but it is stable. It's reached its low point of sorts. Now this 50.1 is a very meager expansion, but it is an expansion, and it's the first one China is experiencing since February 2015. Now, because China is also an export-driven economy, it has to fund most of its uh, growth through debt. And the Chinese debt is topping almost 250%, which is quite an alarming growth considering that this was the debt wasn't even one fourth of it almost 4 years ago. The IMF expects the GDP of China to expand by about 6.6%, and it's expected to expand by 6.2% in the next year. This is primarily because China is still in the investment. It's still in an investment expansion mode. It is slowly shifting to a consumption-driven economic expansion. Now, when China does expand, does change its economic policy into a consumption-driven one, we can expect a lot more stabler growth in China. It may not be as much as 6% or 6.5% as it is running right now, but it will nonetheless be stable. Now, because of China, a lot of other economies are experiencing slowdown. ASEAN economies, which is basically the Southeast Asian economies, are very heavily dependent on China. For example, Thailand has almost 80% exposure of its trade to China. Now, because of the Chinese slowdown, the demand for chemicals and rubber, which is one of Thailand's biggest exports to China, has dropped. The prices have gone down, and this is affecting Thailand. So while Thailand was experiencing a 7% expansion in manufacturing activity in 2010 to 13, it's dropped to 1% now. This is not just the case with Thailand, but in other Asian economies also. Like for example, Malaysia. The Malaysia's PMI has been contracting for the last 18 months, and it's continuing to drop. The other focus of emerging economies is in Latin America. Again, they are almost entirely dependent on China because Latin American economies export commodities. Brazil, which, as some of you may be aware, has petroleum and tin, which is primarily exported to China. And because of the slowdown in China, Brazil's exports have also been hit. So industrial output, which had sort of a steady gain over the last 5 months, suddenly dropped by 3.8% in August. Now this was more than enough to wipe out all the gains that were made over those 5 months. Similarly, unemployment also has been rising. Unemployment was at 8.8% in September 2015. It is now 11.8%. Wages have dropped because Brazil is in a chronic recession right now. And Brazil is in a somewhat worse off situation than what India was in the 2013. India faced stagnation as well as inflation. In Brazil, it is an inflation and recession, which makes things a lot more worse for Brazil. So inflation is close to 9% in September, in the week ending of September 2016. This is more than double what is targeted. What is the targeted 4.5% inflation rate by the Central Bank of Brazil. Now, Chile is supposed to be the most stable economy in Latin America because of robust financial policies. Even Chile could not escape the global slowdown caused in the emerging economies caused by China. its economy shrank by 0.3% in the quarter ending June. However, we don't expect Chile to hit recession. We expect that this drop in GDP is just a one-time event, because data in August indicates that industrial activity has expanded by 2.8% and unemployment has fallen by 0.2% or 20 basis points. So while unemployment was at 7.1% in August 2015, it's dropped to in July 2016. It's dropped to 6.9% in August 2016. So Chile is expected to expand by 1.75% this year. But because China is still not yet in expansion mode, the commodity prices are still continuing to drop. And as long as they keep dropping, there is little scope for Latin American economies to expand. Now, if you look at commodities assets, most recently there was, about 2 weeks ago, there was a meeting conducted by OPEC, that is the oil producing exporting countries. There is so they had the members of OPEC have political reasons to not comply with OPEC's decisions. However, they have agreed, so to speak, to reduce the oil production to about 33 million barrels a day maximum. Now, if this plan is implemented, oil will be trading between $55 to $60 a barrel. Presently, oil production is at about 33.75 million barrels per day. Now, OPEC does not have members across all the oil producing countries. For example, Russia, Norway, Canada. They are all oil producing and exporting countries, but they are not part of the OPEC. So if the OPEC does actually implement the cut down in production, this is going to benefit the non-OPEC members. They have a reason to continue production as it is, and they also have the benefit of reaping the benefits of the rising oil prices. So it was no wonder that once the news of the OPEC's deal was announced, the Russian ruble, which has been quite unstable lately, became the best performing emerging market currency. Moving on to gold and other precious metals. Gold prices depend largely on US events, because the US dollar and the gold are seen as hedges. If the economic output of the United States seems reasonable, there will be higher investment in the dollar, weakening the gold. So recently, when the announcement of the better US manufacturing data was announced, the investment in dollar strengthened, consequently weakening the gold. However, yesterday, with the announcement of the less than expected jobs addition, the dollar did weaken, and we expect the gold will rally a bit more. The price of gold on October 4th was about $1,271 per ounce. It's the weakest price that the gold has seen since before Brexit. Further, the price of gold may drop in the immediate term because there is lower demand for gold in China and India. We do expect that there might be a slight increase in demand for gold towards the end of October, especially because that's when India celebrates Diwali. But going further, the prices of gold will be determined by the outcome of the presidential elections. Most of Wall Street and corporates are backing Hillary Clinton. If she wins the election, then the dollar value will increase, thereby decreasing the value of gold. But if Donald Trump becomes the president, gold will become a much more favored investment. Now, um, other commodities like industrial metals are still dropping because China still hasn't been able to recover, and China has put a cap on its coal production because of overcapacity. Now, because of this cap, coal prices did increase over the last month, and it is slated to increase a bit more because steel mills in China and power plants are forced to import coal from other coal exporting markets, primarily like Australia. Now, this will, however, be more of a temporary gain because over time China will seek to protect its finances. Thereby, it will raise the cap on how much coal can be produced in China. Now, how will all of this reflect in India? See, low commodity prices means India can import at a much cheaper rate. And because the demand for manufactured goods globally also is low, the rates are also low. This once again benefits India for all the goods that it imports from foreign countries. Now, because of the drop in commodity prices and because of the drop in manufactured goods abroad, the current account deficit is at a decade low of $300 million. It's just 1.1% of the GDP. However, we expected that the current account would be in a surplus of about 0.5%. Now, because of the lower cost of goods internationally, our balance of payments is also seeing a healthy positive. So even though FDI did fall over the last few months, the balance of payments still remains in surplus. Now, these factors have helped in strengthening the rupee. The monsoon has also helped in keeping the inflation down. CPI was at about 5.05% in August. Now, this is slightly over what the RBI had kept as a target, which is about 5%, so that it could cut down the lending rates. However, even though it was slightly over the 5% rate, the RBI did proceed to cut down the lending rates by about 25 basis points. However, we are not sure how this is going to pan out, because if the OPEC deal is reached, the price of oil will rise. And if it rises, we also expect that the price of the Indian food basket will also rise, thereby raising the consumer price index or increasing the inflation rate. So the RBI has reduced the lending rates by about 25 basis points, but we don't really foresee much of a benefit from it, because historically, even though the RBI has reduced about 125 basis points over the last 1.5 years, the actual passing down of these lending rates by the banks themselves has been only about 50 to 75 basis points. A lot of banks did not immediately cut down their lending rates after the announcement of the cut down of the lending rates by the RBI. However, there were a few banks that did announce cut in their lending rates for home loans. So maybe we could see a boom in the home loans and real estate market. Maybe not, because like I said, 125 basis points cut down by the RBI, but what's passed down to the end customer is only about 50 basis points tops. Also, the real estate cycle, the real estate investment follows a cycle like any other investment cycle. It is currently in a correction phase, and we don't expect that boom will happen within next few quarters at least. But if you look at the historical data, Real estate boomed in 1988 to 1992, once again from 2004 to 2013. Now, 1988 to 92 was when India opened up its economy. 2004 to 13 was when India was in its boom years of IT export. Right now, the world is slow, so is India. So investment in real estate may not be giving you much yield, even though there is a cut down in the lending rates for the home loan. So if you look at the residential projects, compared to this year, compared to the period of January to March 2016 and Jan to March 2015, there is an increase in the amount of unsold inventory across countries. Many of the increase in unsold inventories tops 15%. So what does this mean? Even if there is a cut down in the lending rates by the banks, customers are not really willing to buy them. Why? Because of affordability. The real estate market boomed from 2004 to 13. It boomed so much that wage growth was not able to keep up with it. Now, because the wage growth was not able to keep up with it, the affordability of these real estate fell. And if you look at some of the real estate companies themselves, they had borrowed heavily from various lending companies, including banks. And because they weren't able to sell this inventory, they've defaulted a lot of the loans. So the banks will be all the more hesitant to lend to these construction companies, so to speak. While the home loan may be around 9 to 10% lending rates for the average customer, the rates are about 22 to 25% for the construction companies. So we may not really see much of a pickup in the real estate sector despite the rate cut. Now, affordability is a problem not just in India, but it is a problem across the world. If you look at China also, the Chinese real estate is still booming. But if you look at some of the underlying numbers, you can see that, let us say that the average Chinese earns about 50,000 yuan per household. The average cost of a house in square meters is about 48,000 yuan. So basically, 1 square meter is equivalent to almost 1 year's worth salary for the average Chinese. Now, this is just considering the per capita GDP, but if you consider the actual salary, it will be much lower than this. So while the price to income ratio at the moment is about 40, considering the per capita income per household, if you look at the actual income, considering the amount of cash available to make the payment, this ratio goes to over 80. Similar to Indian companies, the Chinese real estate companies also are seeing uneven growth. While there is boom in some key cities like Shanghai, Beijing, Shenzhen, Guangdong, it is not uniform all across. So if these Chinese companies have to keep the cash flow steady, they have to borrow. And if they have to borrow, they will be adding to the already booming debt to GDP in China, which is already at 250%. Now, if these companies have to invest more, they're going to have to borrow more. And that is going to be a problem for all of us. Now, if we had previously discussed in the previous two sessions about how China is trying to boost its GDP by investing in infrastructure and manufacturing. The emphasis on Chinese investment in infrastructure led to a lot of housing projects, building megacities. Now the problem is, even though these megacities were built, the occupancy of these cities are less than 2%, which means that these cities are essentially ghost cities. They are just buildings, but nobody's buying them. Nobody's occupying them. This will further aggravate the debt crisis that China is potentially facing at the moment. Looking at USA and Europe, once again, the Brexit plays out, wreaks havoc in the investment sentiment across Europe. Prior to Brexit, if you look at London alone, the property investment in London was topping $25 billion. But if you look at it, 1 year ago it was $36 billion. There is a drop of about $11 billion, especially only because of the uncertainty in Brexit during that time. We expect that this will further go down because Brexit has already happened. However, if you look at the pound sterling, it has weakened because of the Brexit, and this has encouraged investors from all across the globe, China, the Middle East, USA, they are buying British property now because the pound sterling is weaker compared to the currency at the moment. So, although the amount of investment in London is dropping, it is still one of the top 3 investment destinations in the world. In other areas of the European Union, countries with a rather favorable economic outlook are booming. Germany, which is the economic engine of the European Union, that is attracting a lot of investments. Ireland, as we had said previously, the Celtic Tiger, which has been seeing years of very high growth in GDP compared to average, even that is attracting a lot of investment in real estate. In the United States, once again, the affordability is becoming a factor for growth in real estate investments. Although home sales have been growing over the last year, it has dropped in August by almost about 10%. The inventory of homes also fell by about 10.1%. Now, this drop in home loan, this drop in inventory is actually driving the prices of properties up, and this is equivalent to about 5.1% increase in the price of a house, which is almost equal to roughly about $240,000 per home. Now, this rise in the prices is not. This cannot be met by the average American because of the rather slow growth in the wages. The biggest decline in the home sales have been in the southern United States, areas like Texas, which is typically the largest home market. However, there is a small increase of over 1.3% in sales in the northeastern region of United States, areas of New York and Colombia. Looking at all this, how do we design what a portfolio looks like? So as I had said, the real estate market may not be looking at a boom for the next couple of quarters. So it may not be the best idea to look at real estate as an investment right now. However, if you are looking to buy a home, congratulations, now is a nice time. Looking at the equity markets, over the last, over most of September, it has been rather range bound or slightly dropping. But this is primarily due to global cues and due to profit booking. Recently, due to surgical strikes, there was a loss of almost 465 points in the Sensex. However, because nothing of major consequence happened after that, within 2 days, the Sensex was able to recover the losses. Equities will continue to be ranged, or it will be negative in the immediate term. But the macroeconomy is still good. So even though there may be volatility and drop in the short term, we expect that it is going to rally. Now, looking at the, as we had discussed under gold, the US election, which is going to be happening in November, will determine which direction that the gold will take. And if Donald Trump becomes the president, we expect that the gold prices will go up, and if it's Hillary Clinton, the prices of gold will hold steady, or it will actually drop. So there is an uncertainty in what the price of gold will be, and there is actually an uncertainty in what the economic outlook of US itself is. Similarly, Britain's exit policy from the European Union is also a big uncertainty. Essentially, during times of uncertainty, gold becomes a preferred instrument of investment. So, while gold prices are still low, investment in gold at this moment will be kind of beneficial. But you should not have an exposure to gold for over 5 to 10% of your portfolio. In the third week of September, the RBI had auctioned some of the 10-year government bonds, and for the first time, it had kept a cap of 6.97% as the yield rate. But on auctioning, the actual yield rates are at about 6.85%. This is the first time that the yield rates are below 7% in July 2009. Now, if you had joined the webinar, if you had seen a webinar about 2 months ago when we discussed about bond prices, as bond prices increase, the price of the yield of bond decreases. Now, from this very massive drop in the yield rates, you can clearly understand that the prices of bonds are actually rising. Now, it is good to have an exposure to bond in such a case, because bond also offers stability to your portfolio, where equity introduces volatility. So that brings us to the end of our webinar session. Thank you very much for your participation. Feel free to reach out to us in case you do have any queries. We'll be very happy to resolve them for you. Please send any questions you have regarding investments to research@ArthaYantra.com.